Good morning, everyone, and thank you very much for joining me. This is the morning market review. It's Friday, it's the 25th of November 2022. My name is Russell Shaw. I'm a senior market specialist at FXCM. My email address is rshaw@fxcm.com. Just going to go ahead and bring up the high risk investment warning. All right. Can you guys see the screen and hear me okay? Just want to double check. Okay, good. All right. Good. All right, let's bring up the market commentaries disclaimer. Just our references: Market Scope, TradingView, Bloomberg, and Forex Factory with Bloomberg. We just go through very quickly the email. The first headline reads: Global slowdown. Excuse me. The world economy will be as weak next year as it was in 2009 after the financial crisis. As the conflict in the Ukraine risks becoming a forever war, the Institute of International Finance said. Next headline, panic buying. Supermarket delivery apps in Beijing are being overwhelmed as the city's rising COVID caseload triggers lockdown-like restrictions in the Chinese capital. Oil logjam. European diplomats are locked in negotiations over how strict a price cap on Russian oil should be, revealing divisions in the bloc. Poland rejected the EU's executive arm's proposed price of $65 per barrel as being too soft on Moscow. Greece, a massive player in the oil shipping industry, doesn't want to go below $70. Twitter amnesty. Elon Musk said Twitter will vastly expand the reinstatement of banned users from next week in a major reversal of the site's content moderation policies. And this was in response to a poll conducted by Musk. About 72% of participants voted in favor of a general amnesty for suspended accounts. European equity futures indicated a subdued market open. US markets were closed for Thanksgiving, and I think they're open today actually, but usually it's a long weekend. A lot of traders and participants take the Friday off, so I would suspect there's going to be less liquidity than normal today. Let's go through to this chart over here. Okay, so I think this is an interesting chart. So it's another sort of another way of looking at the real yield. So the top chart is our US 10-year minus break even. That's this chart over here. The bottom chart is the euro, and what I want to show you guys is from the week starting Monday 17th. So you get a what looks like the peak of the real yield. It comes in pretty close to the trough of euro. There's maybe a few weeks difference, but by and large, I think that we can see as the real yield shows signs of decline, you can see how the euro is really benefiting from that. And what we can do is we can actually bring in the US dollar here, just underneath. And you can see that, again, as the real yield declines, so the dollar is declining, so the euro is showing signs of appreciation. So it's it seems to be, we're in a new market cycle, whereas the previous cycle was really all about greenback strength. There is now an argument to be made that we've hit the peak there, we've hit the apex, and that the cycle now has turned. If that is the case, and we'll obviously need to monitor it, but it looks more and more like that is the reality of on the ground. But again, let's just monitor it. Then our strategy has to change. We have to evolve with this new market cycle. The fundamentals here, I would suggest, are still tricky, and we want to keep an eye on the M2 money supply. So let's just take a look at M2 money supply. Let's keep the real yield in. Let's see if I can find this. M2 money stock. All right, let's go to, can't remember which is the one that I looked at. Let's see if this one. All right, so we have to go to the month. So you can see the, let's move this over here. So this just, we've got the US M2 money over here. I'm not quite sure this is the right one. Let me just see. All right, I'll need to take a look. Anyways, here we can see the there is a certain shift over here, okay, and that of course is very much showing an inverse relationship. As the money supply comes down, it makes sense that the interest rates should theoretically move up. So the question is, the fundamentals is, well, how does that factor in now if we start talking about a new cycle? So I think the one way to try and match the theories is to actually introduce a rate of change. So let's introduce a rate of change to the money supply. So what we'll do is we'll just go through the indicators here. And let's just put in an ROC, okay? And what we're going to do is we're going to look at a 12-month rate of change. Let's just make it a little easier on the R. Make it red. Okay. And this is basically the thinking behind the M2 money supply, in that maybe the level of the balance sheet is less important than the momentum in how the balance sheet is growing, okay, which is something I'm not 100% convinced of, just to let you know, but it seems to be something to consider. In other words, as the rate of change of balance sheet appreciation has declined, that actually perhaps would feed into a theory that the real rate can start moderating. If that is the case, so if we can say that the rate of change, the decline in the rate of change of balance sheet assets is more important for the real rate, then that does support the change in the cycle. And if that supports the change in the cycle, then we can go to, okay, dollar peak, euro low. And if that's, if we can make that sort of jump, if we can logically make that jump and say that there is now a switch in terms of the cycles, then we can go and evolve our thinking in the markets. Then we can say, okay, let's see if there is actual market bottoms here. And yesterday we did, let's now go and bring the euro back in here, because I think the euro is a very good instrument to use for this type of analysis. In other words, it represents a general, I think, market phenomena that may be taking place. And that phenomena is all about a market low. So we now tied this in yesterday, and I think it's worth bringing this in again with the COPOC, okay? Because now we're talking about, we're looking specifically for value in a market that's been absolutely battered, okay? Which is an appropriate way of approaching the market after a bear market decline. We want to try and find all those instruments that have been battered left, right, and center, and we want to see if they're now finding new investors, if they're finding new money, if the bids are starting to push up. And here's the COPOC, okay? We want to take a look at COPOC under 0, okay? And the normal COPOC, okay, Edwin COPOC, this would have been a legitimate COPOC signal. A kick up, okay, under 0, that would have been legitimate. Here is the last time it kicked up. Somebody's revving their bike, I beg your pardon. Hope you guys are not getting too disturbed by that. Here's the kick up, and then it takes a few months to get the euro moving up. Here's a kick up over here. So this one's a little bit more more timely, so there's a little bit of a lag here. Let's add in that 3-month moving average just to see if we can get any improvements on the timing here. Here we go. Okay, let's just add this in. Yeah, okay, so that's, you can see here is the crossovers over here. Okay, this one's still got a bit of a lag. We're getting pretty close to the crossover here. But the whole idea is we get pretty good signals here. This one's a bit odd. Okay. These two are better. These two are better. Okay. There's a nice one as well. Remember, you're looking at the monthly. Okay. So we're kind of getting these kick-ups here. Let's just take a look at NASDAQ. Okay, let's just make this logarithmic. Let's throw in the 0 line here. Okay. Okay, so here's the global financial crisis. Okay. Here is the tech wreck. The tech wreck, I think, obviously, because it was so vicious in terms of the growth index, there was this area between here and here actually was this was a false signal, you can see. Then it was kind of indicating that, yeah, we're pretty close to the market low, but it took quite a few months before that low was hit. But we are very close to that a potential peak in CPI, and I just wonder if we get the turn up here in the Nasdaq. Let's take a look at the US 30, and then we'll take a look at the Dow Jones. Just remember that the American indexes today probably have a liquidity issue, lower liquidity today, right? Because of the Thanksgiving long weekend. Okay, shall we looking at the Dow? Okay. So here is the global financial crisis here, right? Here is the tech. Okay, some weakness there, some weakness here. Okay, and now take a look at the Dow Jones, so it's actually starting to curl up. So I don't know what's going to happen here. We can keep an eye on this. So you can see that we're starting to get some movement here on the Dow. Why would the Dow be something to look at? Value stocks, right? Value stocks. Let's take a look at DAX. Okay, let's put in the 0. All right, and let's just put in the verticals. Okay. Put in some nice movement there on the DAX with its signals. Okay. And now you can see, look at the DAX actually starting to curl up here as well. So the idea of these potential market lows, all of a sudden are presenting themselves. And we've been looking for this now for, throughout the year. And it's only now that we're getting these kick-ups. Out of all of these, the Nasdaq's actually the one that's showing the least kick-up here. What we can actually, just as a thought, let's take a look at the ARC Innovation Fund. Let's see what's happening there, which we can use as an index as well, right? All right. So take a look at the ARC Innovation Fund. There's also some sort of kick up here. Okay. Right. So we can see maybe we go to turn here, and maybe the fund gets a break. So we can just keep an eye on that as well. And so we've been looking at this obviously in terms of cycle lows. We've been looking at this in terms of the technicals. Let's just start looking at this in terms of some fundamentals as well. Just try and match the fundamentals with the technicals. We don't want to be looking blindly at the charts. We want to have some sort of sense behind why the charts are doing what they're doing. And I think a good way to start would be looking just at the, let's just take a look at the 10-year. Okay, so instead of taking a look at the real rate here, what we're doing is we're looking at the nominal rate. In other words, we're including we can include an inflation adjustment into it. Let me just redo this. So I think it's appropriate for us to actually keep an eye on the US 10-year for this. I'll tell you why. Let's just bring up Microsoft Paint. So what I want to do is now just bring in the present value. Let me just think how I want to do this. Let's do it this way. So instead of looking at it in terms of discounting, let's just look at it in terms of compounding. Okay. No, that won't work. Just do it. Discounting. Okay, so that's the formula. What I want you guys to do is just to keep an eye on this R. So let's just define what R is here. R equals required rate of return. Okay, and what is included in R? Okay, what's included in R? So R equals real rate plus inflation adjustment. Okay, adjustment plus risk premiums. Okay, that's what we're going to call it, and that's why we're using. That's why we're not looking at the real rate. We're looking at the nominal rate, because real plus inflation. That's what nominal is, and then we're going to include. Well, if we want to go into cycle lows, we need to be rewarded with some premiums as well. In other words, we're not going to put our money into bank accounts. We want more than what the bank account's going to give us. The bank account's just going to give us the real plus inflation. We actually want the real plus inflation plus a risk premium. If we can get a risk premium, then we're okay. We'll take a look and see if we can find some, some investments on the stock market. In other words, okay, we're now getting to a point where there could possibly be an apex. Okay. There's possibly an apex here. Okay. We might start seeing this starting out. That's the kind of the theory that we are exploring. If there is going to be a cycle low, okay, then we would want to see this starting to come down. In other words, we go back here. Okay. This R theoretically should start coming down. Okay. This should start coming down. If it starts coming down, okay, then we should start seeing present value moving up. Why? It's because it is R is a denominator, is a denominator. Present values cycle lows that come in, and if there are cycle lows, then we can start looking for value, and that's effectively what we're seeing now as we move into 2023. Okay. That's effectively what we're seeing as we go into 2023 now. Can I just do a sound check and a video check? Can you guys still hear me and see the screen? Because I did get an error message pop up here. You guys okay with what you can hear and see? Okay, good. All right, very good. So let's just take a look at one more chart, and then we'll call it a morning. Let's take a look at one more chart, and we'll call it a morning. And what we want to do is we want to go back to trading view. And what we'll do here is we'll take a look at the Vanguard growth versus the Vanguard value funds, and we'll do a relative strength. I can't quite remember the ticker codes. Let me just see if I can find them. So here's the VUG, so let's bring that up. Okay, so here's growth, and what we want to do, let's just, I think it's VVG, let's just see if that's right. Not quite. Vanguard value. This is it, the VTV. VUG to VTV. All right, so we've got the growth still getting quite badly mauled here compared to the value guys. What's interesting here is let's see if we get some sort of bullish candle here. That would be interesting. Let's go down to the weeklies, and we would want to see if the if the growth can start responding. So if the interest rates start coming down, then hopefully we can see some growth starting to respond to that as well. In other words, the defensive sectors are now hopefully sort of rotating into the more aggressive sectors, which would be, I think, a sign that we're moving from that panic stage, the panic selling stage, into that renewed confidence stage. So you can see, I think there are elements here for us to keep an eye on. Can I call a market bottom? And of course, I cannot. Nobody can. We can only call a market bottom after the fact. However, it does look as if there are elements that are starting to sneak in, suggesting that, well, there is some value to be had. Good sort of companies now valued at really cheap prices. I think that portfolio managers have to be licking their lips in anticipation, so to speak. So we'll keep an eye on this. We've seen the dollar roll over. That's a big, that in of itself, I think, is a big signal. We've seen the euro now kicking up. That in and of itself is a big signal. We've seen the COPAC indicators now starting to roll up. That in and of itself, I think, is quite significant. I think 2023 becomes a very interesting year. By the way, sorry, just before we do sign out, if you recall in the Bloomberg email that we read, the very first headline was, well, next year is going to be as weak as the 2009 year. So, well, we can just go back to 2009 here. Okay, and you can see, well, okay, the fundamentals may have been weak, but the market was actually showing recovery. Why was it showing recovery while the fundamentals were weak? Because markets are forward-looking. The worst, by the time 2009 came along, the worst sort of was behind. Now it was all about dealing with the after effects. So it took a long time after the global financial crisis for the economics to recover. But the market was always looking forward. That could very much be a theme that we see next year. So although next year may be as weak as 2009, it doesn't necessarily mean that the markets are going to be a bad market. The market may be discounting in the improvements in the future. And where does that discounting take place? Well, as the required return adjusts, prices adjust, and we can hopefully exploit that. So I think we are getting into a very exciting change of the cycle. Whether that is correct or not, I cannot say with any authority. Well, I can't say that with any definite, yes, we've hit a cycle low. I certainly can't say that. But I can say that there is a certain amount of signal that is now starting to be generated that bears us keeping an eye on. Any questions, please go ahead and type those in. If there's any questions, please go ahead and type those in. Okay, cool. I think, thank you very much, Indran. Let's wrap up here, guys. I want to wish you a good day, a good weekend ahead. Springboks, England this weekend, right? Let's see how we go, Rob. All right, and I will catch up with you guys on Monday, bright and early. Thank you very much, guys.